It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the mayor of Beckerville, USA, because he owns so much real estate in Texas, they should be picking him up in a 36-foot limousine. Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Ready to kind of continue the first quarter off to a pretty good start. And how's the debt market out there right now?
Right now, I think it's pretty solid. Just in the last 2 weeks or so, Fannie Mae and Freddie Mac have expanded their caps where they were X and now they're Y. So they're expecting a lot more business than they were from what they previously budgeted. So I'm not going to say it's unbelievable amounts of fresh capital if you are thinking about buying a multifamily property, but it's still unbelievable amounts of fresh capital if you want to buy a multifamily property. So jump into the water. The temperature in the pool is good. And so let's get going with multifamily. Michael, what is going on in your world these days?
Yeah, just trying to go find some new deals, kind of in the middle of wrapping up kind of tax return hell that we kind of always go through in January, where really hell starts in December. So December through February is kind of a big crunch time for us, getting our 1,300 and some odd K1s out this year. So that's been good, trying to keep that train on the tracks and get all those out on a timely fashion for everybody. So ready to get back my life and move on to some more fun things. I know you just had the Old Capital Speaker Series, and I don't know if you have a next one already planned, but maybe how do people, Paul? I thought that turned out pretty good. Just talked about the secondary markets and kind of, some of these people leaving, get priced out of the primary markets to go in the secondary markets, and kind of what does that look like? Any sort of kind of quick little thoughts on that? And I'm not go too deep into it, but how do people find out about the next speaker series? And I don't know if you already got the topic scheduled or where did they find out about the upcoming ones when you guys get those put together?
Great question, Michael. Thank you. oldcapitalpodcast.com, oldcapitalpodcast.com. Yeah, the speaker series for the secondary markets was an excellent one because we drilled down about of what's going on in terms of deal flow in some of these smaller markets. As you know, if you're no longer chained to your desk up in San Jose, California, now you can go out and get into the freedom or into the wild of living any place you want to a certain extent. Being close to an airport, maybe to get back to the mothership of Silicon Valley. A lot of people now are looking to live in different areas, and I've never seen residential real estate go up in such a large value percentage in the last, say, year or so since COVID happened, because they've been, a lot of these folks that lived up in Los Angeles or San Francisco, now they can live any place. They can live up in Idaho. They can live in Montana. They can live any place they want to live and just be connected to their computer. So that has been a little bit of a paradigm shift in multifamily. Now folks can live any place they want to, and they do, sometimes to avoid state income taxes like they do here in Texas and Florida. So great conference. Again, go oldcapitalpodcast.com to reserve for the February meeting. Again, as you know, Michael Becker, longtime multifamily commercial banker, made the transition a number of years ago into ownership, and now his group over at SPI Advisory has gone from having 0 up to 10,000 plus units. So he has gone from being a loaner of money to an owner of real estate, a great operator. So we ask him a series of questions, and with his benefit, we get hopefully tight answers for you to understand. Question that came in, Michael, which I thought was pretty good and interesting. Michael, I was thinking of attending an educational / mentoring group in March. I know that you didn't do that, but what do you suggest? Is this a good idea? Is that going to be able to get my business going faster than doing books and tapes and everything on the internet?
Yeah, I think it's a great way to really shortcut a lot of the learning curve that, like you and I get into this business, Paul, we got in the tougher way. We, worked for a bank, and then we just made, hundreds and hundreds of not, I guess thousands of loans in your case, Paul. And just really kind of learned kind of just through doing so many deals, which was an unbelievable education. I wouldn't trade it for the world, and it really kind of set me up to be extremely successful and kind of hit the ground running, just kind of, seeing deal after deal after deal and getting these relationships and seeing the things that work and the things that don't work. But a lot of people, or the vast majority of people, don't have the benefit of, getting into the finance industry like you and I did, Paul, or a lot of people like the prior show that we played a recording of, Mike Oxtein came in through the brokerage side of the business. It's usually a lot of the ways some people come in. So if you don't have that benefit, you're just an engineer and you do IT engineering, or you're a salesperson, or a doctor, or whatever your professional background is, and you want to transition into the multifamily space, and you either want to be general partner or sponsor like I am, or if you just simply want to know a little bit more about your interest in space, and you're fascinated, you listen to podcasts like this, and you want to invest, but you don't want to get taken advantage of, and you want to learn learn a little bit about how do you separate better deals from the less quality deals, and kind of how do you get networked to even get access to some of these deals. I think these mentoring clubs are really kind of transformed quite a bit in our career. You and I, back when I was a banker, we used to do a whole bunch of loans to one of them here in Dallas. I mean, we did, virtually all the loans that they did for, 2 or 3 year window. I mean, we pretty much, you did all of them, and I did probably 70% of those when I was at the bank. I mean, we did a hell of a lot of loans together. And now there's, other groups, there's kind of, higher quality ones, and, some knockoff ones. I'm not going to try to name names, but, there's some kind of the poor man version options out there, as well as the space has got a lot more interest. All of a sudden, when you and I started our podcast 6 years ago, we were kind of a bunch of guys that did a bunch of deals and started a podcast. Now there's a bajillion podcasts out there with a bunch of people that want to do deals, and they're starting the podcast to try to, get a name and, learn along the way, which there's nothing necessarily wrong with that. I'm not trying to talk down about it, but it's just, it's confusing out there when you're trying to start out, and, who should I listen to? Who should I not listen to? Hopefully when you listen to Paul and I talk, you can tell that we've, been through the war and came out the other side of it, and have, maybe a few battle scars along the way. So kind of imparting, there's book knowledge and seat knowledge, and hopefully we're imparting some seat knowledge, not just the book knowledge, but, actual experience from doing, many transactions. So, getting set up, and how do you compress your learning curve? I think these mentoring clubs, or if you get hooked up with the right one, and maybe reach out to Paul offline, and he can probably give you his opinion on it without trying to say too many names on the show. Kind of ones that we think are a little bit more credible and do a good job, and kind of maybe the ones that necessarily aren't. I think that's a great way. It's obviously not free, but nothing in this world is free. Either you pay for it with some dollars up front, and a fee basically to have that person, teach you what they know and go through the program, or you pay for it by, a lot of your time by, failing and kind of overcoming that and learning it the hard way through some lessons, or potentially even worse, getting into a deal and being successful buying a deal, but you buy the wrong deal and you lose a bunch of money, and, it could go much worse. So I think that's a great way to kind of shortcut the education, and then, really get networked and meet a whole lot of people that can help you grow in this business and do transactions.
If somebody were to get into one of these mentoring groups, off the top of your head, I mean, and you're familiar with these groups, what should be 1, 2, or 3 things that you should come out of it knowing? What's the most important things in your mind, Michael, that an investor or a limited partner should get out of it?
Yeah, I mean, there's really kind of a two-pronged thing, really. One of it is the education. So, are you getting with the right person that's teaching you the basic foundation of the business, and you're getting the right fundamentals so you can, make, good quality investment decisions kind of coming out of it. So I think that's one aspect of it. So someone that's, been there, done that, proven, some of these groups have been around a long time at this point now. So maybe getting with a little bit more seasoned group, and, might cost a little bit more money, or are you going to pay, 1/4 of the cost, but you get with a guy that's been doing this for 1 or 2 years, and maybe the market's been going good the entire time they've been in the business, so maybe you're not getting the best fundamentals. So that's one aspect of it. Then the other aspect really is, how, if I join one of these groups, can I get networked with the people that can help me, one, get all the service providers I need to be able to do this transaction? Because as we all talk about, this is a team sport. So, do I get introduced to Paul Peoples and Old Capital to help me with the debt? Do I get a lawyer? Do I get with management companies? That's one aspect of it. And then the other aspect is, can I meet other people that I could raise capital from that are interested in being, passive investors, or maybe meet a future business partner we can kind of co-sponsor these deals with. So that's the other aspect. Are you in a room where there's everything you need to kind of put one of these deals together? So, and those are kind of, varying degrees of success. Some of these people that have educational platforms, I think, really just a way of raising capital from some of these folks, and that's not necessarily a bad thing. I'm not trying to say that's a bad thing, but all these programs aren't created equal, and it's confusing. So, I think maybe reaching out to the Old Capital guys, they probably all have their various opinions of the ones they work with, and there's some, like I said, several good ones out there, and I think kind of working through that would certainly be a key in making a decision. And go listen to some past interviews that we did on our show, and you kind of hear some of the people that run some of these programs that we've had on the Old Capital podcast in the past. So maybe that's a clue on some of the ones that we like a little bit more than the other ones.
One of the questions I always have too is sponsors that are putting together the deal. They put together the deal in Kansas City, and now they want to leave Kansas City because now they want to go into Augusta, Georgia. Then they leave Augusta, Georgia, and they want to go to Phoenix, Arizona. They're nomads when it comes to investing their money and your money into an area that they're not really familiar with. I know that I don't like that, but what is your take on that, Michael? Obviously, you guys have focused in one area. Tell me what the pluses and the minuses are of that thinking.
Yeah, it's really, really hard to do this business well when you're in, one basic area like I am. We're in Texas, so we're in Dallas, and then we went to Austin a few years ago. But we had a really solid base in Dallas, and now we're kind of finishing off growing a really solid base in Austin, and we have physical offices in both the markets that we participate in, really. So it's kind of hard enough doing this business when you're really focused like we are. I can only imagine if you're a little less experienced, and then you're, like you said, being a GP in Georgia and a GP in Missouri and a GP in Arizona, and then how you've only been in the business a year or two, how the hell do you manage all this? You got 3 different management companies, and really that's one aspect of it. And then I think the other aspect really is if you want to do this business right, and you want to be a good acquisitions person and buying the better quality deals from just kind of the okay deals, how do you establish these relationships with these brokers that control 90+% of these deals? How do you really get deep relationships with these people if you're just kind of like a nomad, like you said, bouncing from market to market, and you go into these markets that are small and you just don't have that much opportunity? So we've chosen, right or wrong, I think it's the right decision to focus on a couple markets that are pretty big markets with a lot of transaction volume, and really try to go deep. And once I get a relationship with this broker and really formed it, I want to be able to monetize that relationship, over and over and over again. And as we record this, I just had a dinner with some of the brokers that we just bought a property with Paul in December of last year. And we had a kind of a closing dinner, and it was, I think, our 8th or 9th transaction, and we're finishing another deal with them right now. So I think that's the deal we're buying now is our 9th transaction with them. So doing that first deal, we've been able to repeatedly monetize that relationship and have, confidence and trust in each other to do these deals. And you can't build those deep relationships if you're bouncing from, Georgia to Missouri to Arizona. So as you're starting out, I think really focusing on one area, getting the base, really, and then once you kind of got a good base down, I think it's okay to expand to another market and then maybe another market. But, trying to do that out of the gate, I think is extremely challenging. And I don't think that you're going to have the same level of success if you're a little bit more focused.
I definitely agree with that. To stay in one area, go as deep with the relationship as possible in that one area. If you live in Kansas City and you're looking to make a position in Phoenix, stay in Phoenix for the next 5, 10, 15 transactions. Don't go into other areas. It is absolutely damn near impossible to build those relationships. You're not going to get deals off market. You're not going to build the relationships with your vendors that are supporting you, whether it's the plumbers or the roofers. You're just going to be a nomad walking through, and everybody's going to treat you for the highest prices possible. You're not going to get deals that you're going to get the same deals that everybody else is going to get to in the marketplace itself. And you may think that you're doing well, but you want to go deep with those relationships. Another question, just common question, is having these sponsors put money into the deals, their own money into the transactions. I've seen a lot of these sponsors or sponsorship groups that go in and are buying a deal in Jacksonville, Florida, as an example, and they're out to raise a bunch of money, and they don't personally want to put money into these deals. Now, I want you to put your former banker's hat on, Michael, not the Fannie Mae, Freddie Mac banker's hat on, and then I want you to put the syndicator's hat on too. Let's take a look through the different lenses that you bring in perspective to the deal.
Yeah, I think it's I mean, everyone starts from zero. You got to do your first deal, and everyone's kind of got different professional background and financial resources and things. So I think, depending on where you are, kind of, you only have so much ability to put capital into deals. So I get it when you're starting out, you don't have the same level of resources that you might have if you go full cycle on a bunch of deals and have a little bit more cash. So, but at the end of the day, I think it's important, just kind of fundamentally, when you're looking to go attract capital or equity or debt, that your partners in these deals, whether at the bank that gives you the debt or your passive investors that give you equity, that you have some level of material skin in the game, whether that's 10% of the cash down or 0.5% or whatever it is. It's got to be material to you. We didn't like at the bank that I worked at is, when we didn't have a good chunk of the equity come from the people that are signing on my mortgage. So we really required that we had a pretty large percentage of the equity come from the people that are going to be guaranteeing my loan. So I did a recourse debt back in the day. That's where we did a bunch of debt and kind of cut the teeth. And Fannie Mae doesn't care quite as much. But I think if you're coming in with no money in the deal, it's going to be extremely hard to attract capital from both debt and equity. So having some skin in the game, because if the deal kind of goes sideways, I mean, I can remember some times where I inherited a loan. It wasn't a multifamily deal, but we had a industrial flex kind of office industrial kind of flex space. And we had the sponsor that guaranteed the loan didn't have any cash in the deal, and all the cash that that was put in the deal came from people that didn't sign my loan. And then 2008, 2009, kind of the deal starts going a little bit sideways. And then we started realizing that I had a real problem here, because the sponsor wasn't going to put money in the deal because he didn't have any cash in it, and he didn't want to throw good money after bags. He didn't have any equity in it, and just kind of signed my mortgage. And then all the people that had put money in it didn't sign the mortgage are like, shoot, all my equity's gone. Why would I throw more money in it? And I don't have anything else to lose, so I didn't guarantee the loan. So then I kind of got caught in the middle as the bank. And really was, you read all these things as a young banker, kind of your credit policy, and kind of hear about it. It's one thing to kind of hear about it, it's another than kind of experience the real world ramifications of not having aligned interests. And that was a good example I can think of back from 12, 13 years ago, I guess, at this point, that seeing how these deals kind of go sideways when you don't have proper structure and aligned interest along the way on the front end of these deals.
And the reason why I bring that question up is really two questions again, and then we'll move on. One, you guys at SPI put significant cash in every transaction that comes out of your pocket. This is not made up cash. This is cash that comes, hard money that goes into these deals. And then second, you guys had just recently done a loan where you guys typically do non-recourse, but you did a bank bridge loan on it that you and your partners signed on behalf of the partnership. Personal liability is, tell us a little bit about that.
Yeah, generally allergic to recourse, Paul, like most people should be if you do this business, and Paul can help you stay allergic to it. But this particular situation, we're buying a deal in a submarket that this was a fifth property we owned in the submarket, and it was a A- deal that was right across the street from a deal that we sold about a year prior. And so we felt like we really understood kind of the area. And as I think we probably joked previously on this podcast, Paul sometimes not only calls me the mayor or the governor, but sometimes Dr. Becker, because I was in college for so long. And this was right next to the university I went to. So I got, my great 8 years in college.
Right, Dr. Becker.
That's right. Beat Tommy Boy by 1 year, So anyways, felt like we really understood the area, the submarket, and the deal was historically performed really well. And then COVID kind of caused a hole to pop in the rent roll, because they had a bunch of foreign students that they leased to that when COVID hit, they got overcalled back to their home country. So they had to kind of overnight a big hole get blown in the rent roll. So as they're digging their way out, plus some management issues, and we actually had bought a deal 4 years ago from the same seller. So we're just kind of one of these deals that we felt really comfortable with, and to get better quality debt, lower. The bridge market is improving as we record this, but it's not to where it was a year ago, let's call it, kind of pre-COVID. And so we chose to go with a regional bank and get partial recourse. So we had to sign, I'm trying to remember what it was, Paul, about 25%, I think, of the mortgage balance. is what the recourse that we signed. So if there's a problem, not only do we lose our money, we also could be liable for up to 25% of the mortgage balance. But we felt that was a reasonable risk. We can kind of get in and out of it. It was a pretty straightforward deal. So we will not only put $1 million of our cash in the deal. We also signed, $6 million of recourse each on this particular deal. So we have, some material money and aligned interest. So this deal better work because failure is not an option on this one.
Not an option, but you also put in significant cash into this deal itself.
Yeah, we put 7 figures of hard cash in the deal plus sign material recourse. So it was was a calculated risk. I think we're going to turn out to be just fine. But, if it goes against us, it's, going to be a really, really bad day, obviously. So, like I said, failure is not an option on this one. But it's really straightforward, real down the fairway deal. And I see an easy path to get out of this bridge loan with refinancing it. And we're buying it at what, the recent comp, basically the exact same deal a couple miles away. Right at the time we were getting awarded the deal was selling for 25,000 unit higher than what we bought it. We bought this deal direct off market from a broker that we've done 9 transactions with, or this will be the 9th transaction we did with them. And we did a second transaction with the seller, and they were planning on listing the deal and going wide marketing. And then they had a hole blown in the rent roll, and they pivoted to kind of refinance. So the broker had one shot at getting the deal, and I knew it was coming out. And I tracked this deal for 4 years, and I tracked it for 6 months with this particular broker. And we were there and just kind of stayed on top of it and got awarded the deal. And just a matter of persistence and doing the right thing for many, many years kind of finally paid off in this transaction. And it was an accumulation of the relationship with the seller, the relationship with the broker, me being very diligent and tracking this deal for many, many years and staying on top of it. And it all kind of came together and we got a really good basis. And so that's why we took that little bit of risk, Paul, that we don't typically take. And, hopefully 12 months from now, we won't have that loan on us and we move on to an agency loan or Lifeco loan or sell it for profit. One of those 3 things.
Well, I think that's an important piece for people to understand that are thinking about getting into multifamily, especially investors that are putting their hard-earned cash into a deal. What is my managing member's exposure to this deal? Did they not put any money into the deal? Did they not sign a recourse or a non-recourse loan into the deal? So, what's going to have them committed to making sure this is a success? And that is where I find great operators who kind of put their own money into deals and kind of understand a little bit about the risks of the deals and kind of have a game plan or a pathway for success that have done well. So, talking about people that have done great, and I don't know how you got him on, but we've had him on in the past. But it's a guy that that's owned thousands and thousands of doors, and he's an attorney by trade. And you got him on your new show. Gentleman's name is John Griggs with Presidium. Him and his partner Cross are some of the top talent in Texas. They came out of California. They both went to top law schools. They're smart guys. And tell us a little bit about the conversation you had with John Griggs on your show.
Yeah, so John not only went to Stanford and got a law degree at Michigan, I think he was in college for less time than I was too, Paul. So that tells you can come into this business and be successful from 2 different perspectives, kind of a little bit more Johnny Hustle, or what was the nickname for Pete Rose? Charlie Hustle. That's it.
That's
so, I guess I'm kind of more like that, and John's probably a little smarter than me. But we can both come at this business from 2 different angles and really be successful from different perspectives. And again, like we talked about, I recently started a kind of a complimentary show to the Old Capital podcast. So we've been doing for I guess 6 years now, Paul, and having a few million downloads, which is amazing. When we started Old Capital, Paul and I always joked with Paul that we have, dozens and dozens of listeners, and now we're getting 40,000 downloads. And that's kind of, I'm starting over from scratch and kind of frustrated a little bit trying to grow the listener base of the new show. But it's kind of one of these deals that has inertia and, kind of it takes a little bit of time to get the word out and pass it around. But, one of the things I'm really trying to bring to the marketplace really is a pretty highly produced show, and we're doing it in a studio, and it's really, trying to get really high level guests and trying to take all the relationships I've formed for many, many years here, and kind of without telling you how connected I am, I'm going to show you how connected I am just by the kind of some of the guests you get in this business, and not to brag or anything, but to kind of show from osmosis that this is a relationship business that A lot of it's kind of, I'm not as smart as maybe John Griggs is, and he's got a better IQ and a better pedigree from a educational background, but we both can go out there and, get into a knife fight to try to buy a deal together, and I can win my fair share of those transactions with them. But anyways, as I digress, John came on, really started out doing a lot of workforce housing, came out of California, started buying stuff in Phoenix, got out before everything hit the fan in Phoenix in 06, 07. And started coming to Texas. And so he did a lot of workforce housing, was as successful as anyone else in town, and now he's kind of transitioned into doing a lot of development. And he's honestly bought 100 contiguous acres just south of downtown and a relatively challenging part of town, and a bunch of low density student housing properties. And he's got the most high profile development deal, or one of in all of Austin right now. So it's kind of the hottest market in the entire country, or right there with it. And got the biggest, most high-profile development deal, real complicated deals. We talked a little bit about that on this episode, among other things. So if you want to find more information about that show, it's on, YouTube, which is really kind of as a video podcast. We're also going to release an audio form on iTunes or Stitcher, or you just go to the website, which is www.multifamilyinvestingshow.com. Appreciate everyone that listens to this for many years to subscribe to my new show, and kind of on YouTube or iTunes, really trying to get the word out and kind of see some of my buddies that I do business with, and kind of talk deal stories and try to impart some wisdom from people that have been in the business for a very long time, have done billions and billions of dollars of transaction volume.
Well, I love deal stories, but I also like stories about what's going on in the golden age of multifamily. Are you still thumbs up on multifamily, Michael?
I think it's and John mentioned this on the recording, Paul, that we got a lot of legs left, especially in the kind of the on markets, the Texas, your Arizona, your Floridas. It's a complete shift, and it's kind of like the Dust Bowl of the 30s. People are leaving the Midwest to go to California. It's kind of like the opposite of that, kind of in reverse, where people are leaving the higher regulated tax markets into kind of more markets like Texas and Florida, Arizona, North Carolina, Georgia, places like that. So we think we got many years of growth ahead of us. So definitely thumbs up, Paul.
And if people want to get more information about what you do at SPI, and again, what do you do at SPI?
Yeah, really. So the main company that I run is SPI Advisory. So you can find information about us if you go to our website, which is www.spiadvisory.com. That's SPI like spy. Advisory.com. There's a contact us form. You fill that out, and we'll send you some information about kind of what we do, and get you on our list for future investment opportunities. But the basic focus of the company, Paul, is to put together high quality apartment opportunities and put them out to our database to go raise capital from and operate, and hopefully give you more money back in the future than you gave us. And that's really kind of what we've been focusing the last several years on, and really kind of going forward. That's what we want to focus in 2021, trying to put together 3 or 4 syndications this year.
Fantastic. Thanks for spending some time with us, Michael. I'm really looking forward to watching and listening to John Griggs. So without any further ado, let's listen to you and John Griggs.
Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm excited to have my friend John Griggs on. John, appreciate you joining us today.
Absolutely. Thanks for having me, Mike.
John's the co-CEO and founder of Presidium Group. It's a Dallas/Austin-based multifamily apartment owner, property management company, developer. You guys do capital. Probably go sell you a car or something to you, a little bit of everything. But John, maybe give the viewers a little bit of a background on yourself. I know you came out of California. You're a lawyer. Somehow you decided to get into workforce housing and then transition and development. So maybe give kind of the cheap version of your background here.
Sure. Thanks again for having me.
Yeah,
and
of course.
Appreciate the introduction. So as you mentioned, I was a lawyer kind of in the early 2000s, and looking to do something more entrepreneurial. And a friend of mine from law school and I, Cross Mosseri, my now business partner, we're in California.
Yep.
And we were looking for kind of real estate opportunities there. It's expensive then, it's expensive now.
What time frame is this?
So this is early 2000s.
Okay, good.
So a while ago.
Yeah.
It feels like yesterday sometimes.
That's right.
But we started buying fourplexes in Arizona in 2003 and really just looking to cash flow them with our own money that we'd saved up from being lawyers, and thought, we'll sell them in 10 years and, pay for our kids' college or something.
Sure.
Fast forward, that market just soared as can happen. And over the next 2 years, prices there almost doubled. We saw that as an opportunity, and we also saw it as a warning sign where things are getting a little frothy. So we sold out of that market and quit our law jobs and started looking for how do we do this on a larger scale. And at that point, kind of like today, there was a fair amount of froth on the coasts and some kind of high price markets. And Texas was one of these places that was still reasonably priced, lots of job growth, lots of population growth, just a good place to do business. So we started putting together partnerships here and bought a bunch of units between 2005 and 2007 with kind of a light value add model, which was kind of what was the predominant focus those days.
What do those deals look like in 05, 06? Like what like size, age, stuff like that? Yeah,
kind of 70s and 80s deals that would be, 150 to 300 units. Back then you're buying for 20s, 30s, 40s a door. And you made it work. And what's interesting back then too is people weren't renovating to the same extent they are now. And I think that we can go into that later, but it's a good development that we've gotten more focused on kind of presenting quality products to tenants.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
Yeah, well, at that time too, I mean, everyone like Kavagimira could buy a house, and that's why your fourplexes in Arizona were doubling in a 2 or 3 year period. So it was a tougher time to be a landlord, to be honest with you, back then than what it's been the last, say, 10 years in a lot of ways, because the demand just wasn't there and the rental rate growth wasn't there in our market because everyone just buy a home. So and then you kind of transition. What was I always like talking to people because a lot of people that watch the show probably have just been in the business the last few years with, the popularity of our industry really growing with shows like this and people getting exposure to it. I just to simply have the exposure to it, 10, 15 years ago. What was it like from like 08 to like 2010? I mean, 2010, in my recollection, was probably the bottom of the bottom. That was the worst year to be an operator. What was that like to try to own and operate and try to manage your way through that?
Yeah, no, I mean, it was a super challenging period and definitely the worst, in multifamily real estate. Thankfully, this last period was not nearly as bad. I mean, it was really kind of, if you imagine the last sort of 5-6 years kind of going in reverse, lately, and again, the last period's been an anomaly, but, every month your rent roll gets a little higher, your occupancy kind of stays high. And there it's just getting a little bit worse and sometimes a lot worse every month. And you're kind of wondering, when does that bottom hit? What it forced us to do was just really get involved in the operation side and to squeeze every, piece of juice you can out of the turnip to make things work. And it turned out to be a good experience from that standpoint, an education, kind of a priceless education that, here's how you operate in the worst of conditions. And here's how you kind of look at things when everything looks good and say, well, what happens if there is a little bit of a downturn, and how are you ready for it? So it was a good education from that. So it'll always be sort of ingrained in my memory is, that things can happen, and there's you got to be ready for it.
That's right. So you coming out of the Great Recession, did you guys buy much stuff between say 08 and 10, or did you just really kind of 11 going forward is kind of when you started kicking it back up?
Exactly. Yeah. I mean, 11, 12, we kind of got back into it, and that was kind of when we really established a programmatic value add platform. And kind of went full speed ahead in the Texas market.
So you guys focus on, I don't think I did a good job on the introduction. You guys focus on Dallas-Fort Worth, you focus on Austin, been in Houston, been in San Antonio. Are there any other non-Texas markets you guys participate in?
There are. So now we're active in Florida as well. We have 2 developments in Jacksonville. We'll have a couple more, hopefully breaking ground this year. And we're closely looking at Phoenix and Tampa.
And then
and also Maine. We have some products up there. So it's
how did you get to Maine?
You know, we met a couple guys that had some interesting assets there that they were chasing, and we partnered up where we kind of provided the capital backing for them and helped to kind of set up the debt and equity, and ended up kind of merging up and having a little platform. It's a neat market. There's a lot of nuances.
So that's the first for me. So as people are watching you, where do you guys sit for like unit count, assets under management? I mean, how many units have you done in you guys, 16, 17-year career?
Yeah, I mean, right now we have a portfolio of about 13,000 units. Okay. We've probably sold another 6,000, I guess, over the years.
Nearly 20,000 units.
About, yeah. And then on the development side, we've either built or have under construction a little under 3,000 units.
Got it. So before we get into development, that's kind of really why I wanted to bring you on to have a conversation with you today. You've really taken from doing the buy with the value add strategy, and it's kind of sold out of a lot of that. I think you still own quite a bit of it, and you now are almost exclusively focused on doing ground up development, for at least from an outsider's perception. That's what I perceive you guys doing, at least. Correct me if I'm wrong, but I think that's kind of been an interesting transition. And there's got to be different skill sets to do development than it does a value add. I know you're doing construction in both, but they're completely different, dealing with the cities and all the headaches. But before we get to the development, maybe talk about the last cycle that we guys were still in. I never really ended. It seems like it was going to end. Yeah. It just keeps going. You're talking about in 2011, 2012, you started buying some stuff. I mean, you're buying 70s vintage, challenging locations in certain respects, and just absolutely crushed it on all these deals. I don't know if there's like maybe a deal or two you could think of that maybe kind of encapsulates what the last 7-8 years have been like for you guys' company in the value add space.
Yeah, no, it's true. What happened really from kind of when we started doing this in 5, 6, 7 to that period, kind of the golden age, as we sort of refer to it as. The ability to push rents just got a lot better, and the ability for tenants to appreciate and afford quality product changed. I mean, it wasn't that long ago in the mid 2000s that the idea of raising rents by $25 or $50 was just unthinkable.
They'd move out immediately, right?
Right. And something changed in that period. I think that obviously this area had a wave of prosperity and continues to. And so when I look at some of the deals that we did, in that period where we'd go into East Dallas or East Austin or Arlington or some of these other places, and you'd go in starting thinking you're going to raise rents by $75 or $100, and by the time you get through it, you're looking at doing a higher level of finish out. You're raising rents $200, $250, even more. And you just kind of had to adjust your mindset to that. And fortunately, kind of the debt and equity understood that too, and kind of shifted their mindset. But that's really by the end of this. I mean, we were, that was kind of our MO, is go in and raise rents, $250, $300 and spend 10, 15, sometimes more, 1,000 per unit doing that. And you'd see whole neighborhoods, like the area kind of over by Forest Lane over in East Dallas.
Like Highlands.
Yeah, exactly. Where you just, things change. I mean, the tenancy changed, the ability for people to pay those rents and their, valuing of what you're providing. It just shifted in a short period of time.
Is there any deal you could think of that maybe kind of illustrates it? Something maybe you bought in 13, 14. I know you bought a deal over off of Walnut Hill. I'm trying to remember the name of it. It looked like a Soviet style housing camp.
Some of them do.
With the foundation issues and all that. I think that deal. I'm trying to remember the name of the deal.
You're probably thinking the link kind of at right on 635. So that was an interesting deal, and it sort of illustrates how what's great about this cycle is multiple groups can make money.
Sure.
So we bought that from a group who had bought it kind of out of foreclosure, and it was just really a tough property. Crime elements were rampant and physical issues, and they really kind of firmed it up and got the tenancy under control, got the management under control. Fixed it up and made it serviceable, and did exceptionally well, and sold it to us at about 4 years ago at a number that felt kind of fully valued at the time. But we thought there was another leg up, so we went in and put in 13,000 a unit.
Oh, wow.
And
what vintage is this? The 80s?
So it's late 70s. Yeah, so around 1980. So and pushed it up that next leg and raised rents $250. And now it's got a great, performance. It stays full. It's very stable. It's very safe. As much as it can be. And so now, it's humming along. And so and of course you've even seen deals where 3 or 4 people can kind of come in and actually make money and the band plays on.
Speaking of that, so I remember I was looking at a deal in 2014 that we got awarded, and I ultimately ended up getting spooked on it. It was called Ridgemar Square.
Oh, sure.
And it was 360 units, had 1 chiller, 2 boilers in West Fort Worth. And I got spooked, and then all of a sudden, 2 months later, John and his group buys it. And then you change the name. And I remember I drove through it about a year after I didn't buy it. And I got spooked because of the chiller, really, because it was like 1 chiller, and it was I was told it was supposed to be like in good condition, and it wasn't. And then I remember seeing the temporary chiller when I drove through it one day. I was like, okay.
That's always a telltale. Yeah.
I was like, at least the chiller, at least my concerns were founded, and John had to deal with that, I'm sure, in August.
Lots of fun.
One year. Let me talk about that deal, because then you ended up selling it to our buddy Scott. Scott ended up selling to another guy.
Yeah.
Maybe talk through that story a little bit.
No, that's an interesting one, because that's an asset it's really well located in West Fort Worth.
And it was unique too. It had the different architectural styles.
Yeah. It was originally developed by the Smothers Brothers.
That's right.
It's kind of random. 70s TV entertainers. But we like the location a lot. I mean, you got multi-million-dollar homes just north of there. You're 10 minutes from downtown Fort Worth.
Yep.
Thought this is a property that can really carry the burden of what you put on it by raising the basis, and can get the rent roll up. So we did a lot of heavy lifting and raised the rent roll and boosted it up and made it kind of interesting and fun. And then Scott came in and did another leg up, a renovation.
Changed the name. So you changed the name to Xander? Or
that was him, yeah. So we were the Realm.
Realm, that's right.
There were 10 different buildings, and each one had a little theme. And there's like the Swedish building and the Dutch building. It was an interesting.
Yeah, it was. And so you paid probably like I remember I was going to buy it like 28 or 29,000 a unit.
A little more than that.
30-ish or something. And he sold it for 50 something. I'm
like
sure.
That. Yeah.
I'm sure it's worth 100,000 today.
I if that's what they say.
That's amazing.
Whatever someone will pay for it.
That's right.
That's it.
So speaking of that, I think a lot of it's kind of the debt. The debt's really improved quite a bit over our careers, right? And then the equity too. Have you noticed any sort of changes, or in particular around, say, the equity, because the debt's really gotten better. You got more interest only. You've got the interest rates have certainly come down quite a bit, so it's making these cap rates kind of drag them down as well. And then you're seeing in at least up until March of last year, we had an extremely robust bridge market out there. There's a lot of debt funds, a lot of banks that kind of went away, and now it's kind of, I think that's back to maybe not to the same level as it was, but it's certainly unthawed quite a bit. So that's certainly kind of been driven on the debt side. But what about the equity? What's different in the type of capital that's seeking you out today versus say 12 or 8 or so years ago, I guess now?
Yeah, I mean, there's been a couple changes. I mean, one's kind of comical is when we started doing this in the mid 2000s. I mean, equity was skittish about Texas. You'd have guys that would come back and say, "Oh my gosh, in 1991 we lost our shirt in Texas."
Sure.
And they had this kind of recency sort of phenomenon and then over time and after the Great Recession, people thought, well, Texas is actually starting to come into its own. I mean, you've got companies like Toyota moving here and companies like Oracle moving here. I mean, this is becoming a real spot. And so the large private equity groups really started to turn on to Texas,
sure,
who were out in New York or California or Chicago or wherever else, many of whom now have offices in Dallas, which is interesting. But that was very much discovered and remains so. But what's interesting, and there's always been the friends and family component. We all know people that want to invest in real estate, and they come to us, and there's that dialogue. But I think what's really interesting is just in the last few years, sort of the democratization of equity and the ability for small investors, individual investors, to access, quality operators and quality product. And you look at how that develops, and I guess back in the day, it was my parents tell me, if you wanted to buy a stock, you had to call your stockbroker and pay him a 2 or 3% commission to do that. Well, Now you don't pay anything. You go online, you do it yourself.
Yeah.
10 years ago, if you wanted to invest in a quality multifamily asset, you really had to know somebody or go through an intermediary who would charge some. And in the last few years, I mean, the internet and crowdfunding in particular has really helped to democratize this, as well as just platforms like yours that get the word out to people who are interested. And
it's amazing to get access to watching. I don't have 20,000 units, or about 10,000 units, about 20,000 units, and you see us talk about, doing these deals as experience, and they can reach out and invest in one of our deals. I mean, it's pretty amazing how that's really transformed the marketplace and really brought a whole lot of eyeballs and a whole lot of potential buyer pools that just weren't here 10 years ago. I mean, it's really amazing. So talk a little bit about this. You've really kind of transitioned from doing a lot of the value add workforce housing in the last 3-4 years. Really, the primary focus of your company has been in ground up development. I saw it today in the paper. Actually, you guys made the Dallas Business Journal as we recorded today. You guys just delivered a deal in Frisco, a senior housing deal in Frisco. I saw them before I drove to the studio today, and I know you guys have one of the most high profile development deals in all of Austin right now. But before we talk about that, what really led the transition? Because you guys were crushing it. The returns on all these value add deals have been great. You get current cash flow to a certain extent on these things. And why are you giving that up to go do ground up development? What drove that? Yeah,
it became kind of a natural evolution as sort of another, the next thing in our business to do. I mean, we sort of had kind of gotten the redevelop or the renovation side kind of locked down, and it's always difficult. There's nuances to it. It's never totally locked down, but it seemed like the next logical step in our business, and so we envisioned it as really another arm in addition to value add. And so we sort of stood up our development team about 5 years ago and hired some top-notch people, and now have a really, I think, a top quality group of folks who have been doing this a long time. And got that part of it. The personnel is a key part. And then started acquiring sites and started acquiring sites around Austin, around DFW, and in Jacksonville, Florida, and some other cities, and started building. And so now we've built, we either have under construction or have delivered 3 in DFW, about to start a 4th, 2 in Austin, about to start 3 and 4 there, a couple in Jacksonville, 1 in San Antonio. So, and we have a lot of sites behind that are coming. So it's been good. It is a much, it's a different business than value add. The time periods are longer. The upfront cash is a lot more. I mean, you're going to spend $1 million on pre-development for really anything that, kind of in that 300 to 400 unit size. So it's daunting. I mean,
so what's kind of the different team members that you had to add when you went to development? Because a lot of people that at least I interact with, we all do the same thing. We do what you do, which is the value add. So like, who did you have to bring on your team to be successful in doing these development deals?
Yeah, I mean, so we brought in some folks who were pretty senior, who kind of had 15 or 20 years experience from some established seasoned developers, and then kind of learn best practices from them and could bring that to us. And then we brought in a president who's a great guy we met through our first Jacksonville deal, who had personally developed about 10,000 apartment units, mostly in Florida, and who came in as leadership for that and set up the structure and set up kind of the MO for how we do all things development related.
Right. So just a complete different division wing of the company.
More or less.
What is the equity for that relative to some of the value add? Is that different, or is it the same pool of equity?
It's slightly different. I mean, some equity groups really want the cash flow, and they're focused on that. So it's a tougher sell to tell them that you're not getting any cash flow for 3 or 4 years.
Sure.
So that's one thing. I mean, most of the larger groups do both. And we're seeing individual investors kind of migrate to it too. I mean, the one good thing about development is if you get it right, and just in kind of round numbers, I mean, building a garden style deal, say here in DFW, you're building it for 155,000, 160,000 a unit, maybe a little more, maybe a little less. If you lease up, if construction goes as planned, if costs come in,
sure,
you're going to sell that for 190 or 200,000 if you can snap your fingers and do it.
Sure.
you're not snapping your fingers and doing it. It takes 3 or 4 years. So
Sure.
You're betting on, there's execution risk, which is what it's our job to mitigate. And then there's just market risk, which is,
out of control.
But if there is an embedded margin kind of looking at going forward, that this is, you're sort of building for wholesale and you can sell for retail, that can compress and it can also expand.
Sure.
And so, you don't know, but there is something that you feel good about, that you're kind of building for wholesale, I guess.
Yeah. And so not only have you just done like the greenfield development, you're currently involved in, I'm sure, a multi-decade development down in Austin right now.
That's right.
You ended up buying in a relatively challenging part of East Austin off of Riverside. You bought around 1,000 units. Maybe talk through that story, the development, because you bought those 2-3 years ago at this point.
That's right. So in addition to kind of I guess we look at our development kind of efforts, and there's a couple nodes. I mean, one is the one-off, or maybe 2-phase or 3-phase standalone multifamily, and then we have a couple large mixed-use projects that we're doing. One is in kind of near East Austin, Riverside Corridor. The other one's out by the Austin Airport. And so the one that's River Park that we just kind of announced, sort of the vision for, it's a bunch of older student housing that's in East Austin. That it's actually not that old, but it's not very dense, and the area around there has gotten a lot denser. Oracle moved its worldwide headquarters there now. A bunch of other kind of companies are circling around it. So clearly, the highest and best use is not surface park spread out student housing that's some distance from the university there. So we programmed it and went through a rezoning process and kind of got all the community stakeholders involved and had long discussions with governmental and other leaders in the area, and made sure that this is something that would be, the highest and best use, but also take into account kind of the needs of the community.
Sure.
And so there's going to be a large affordable housing component. We're going to be delivering a lot more affordable housing than we'll be removing from the market.
Yeah.
And there will be some office component. There'll be some retail, and it should hopefully be a new city center. It's going to take, at least 10 years to fully build out. So we're in the beginning stages, but we're hopeful to start moving dirt on that in the next 12 months.
How many acres is it? I know it's a lot of units.
It is. So it's about 100 acres when you add it all up.
It's all contiguous too, right?
Yeah.
That's so amazing. I remember I saw when you hit the paper a couple years ago when you guys bought it. I was like, man, that's an ambitious program for the guy that owned a bunch of stuff in East Fort Worth.
That's right. Hey, the stuff in East Fort Worth made all that possible.
That's right. That's right. That's amazing. So maybe you're in all the majors in Texas and Jacksonville, and now going to Tampa and hopefully Phoenix. Is there any one market that you like better than the others right now, or they generally all kind of doing pretty good that you participate in?
Yeah, I mean, it's been pretty remarkable. I think if it's amazing just looking at today's world, if you think about what two markets nationally would you want to be in? I mean, to be really focused on, Austin and Dallas Fort Worth are pretty good. I mean, they're very different, but I mean, the momentum moving to Texas is it's relentless. And I talked to friends and colleagues in California, and it went from sort of 15 years ago when I moved here, like, wow, that's kind of a big move, huh? Geez, what's going on in Texas? To 10 years ago, it's like, oh, something's really happening. And 5 years ago, it's like, wow, like I keep hearing chatter that our company might move there. And now you talk to people and they're talking to residential realtors out here looking for houses. I mean, it is, I feel like it's a super cycle that's got, decades of legs, and you're just going to see it continue to strengthen. So we love the Texas markets. Houston hasn't participated to quite the same level, but I feel like there's opportunity there too. And it's sort of had a couple gut punches with weather and with, just the energy market being tough, but you feel like that could take off too, and I feel like that's prime for development. Florida is another great place. I mean, we're kind of actively looking for other developments there, kind of especially in that Jacksonville and I-4 corridor. Yeah. So.
Well, not always Houston, though. They'll always have a storm and oil always busts. So kind of boom or bust, or feast or famine market. As we're now in the first quarter of 2021, maybe look back on 2020. Any sort of observations or challenges that you're proud of your company for kind of overcoming, and then what do you see 2021 kind of going forward as your opportunities?
Yeah, I mean, 2020 was obviously a crazy year in a lot of ways, and hopefully better times are ahead.
Sure.
We really, from when the pandemic started to really emerge in March, I mean, our focus was really largely on keeping our corporate family and our residents safe. And what can we do to kind of stay on the leading edge of that as this developed? And I'm proud that I think we did the best we could on that
Sure.
front. And then it's really, how do you navigate this on an investment basis? And for the first couple months, nothing was really happening transaction wise. And we were figuring out which developments we'd want to go forward on.
Sure.
But interestingly enough, assets that we had, we were about to sell or about to put under contract at the start of the pandemic, they all sold over the course of 2020 at, prices that were as good or better than we thought
Sure.
going into it, which is astonishing in some ways, but
Sure.
but there's good reason for it. And it ended up that I feel like that this just accelerated a lot of trends that were happening anyway.
Sure.
To my early point about just folks moving to Texas and kind of looking for bigger spaces and spreading out a little bit more. It's as wrenching of a year as it was. Hopefully, we all learned some things from the various things that happened in 2021. Last week, notwithstanding, let's hope is off to a new start here, and we'll. I'm generally optimistic that this is going to be a really good year and it's sort of always darkest before the dawn. I mean, the pandemic's raging now. There's lots of just negative things in the news cycle, but once the vaccine gets rolled out, you're going to start to see people come out from the woodwork again. And I'm optimistic by summer we have a return to normalcy, and there will be a frenzy, in my opinion, of activity.
And so you're going to continue trying to acquire new sites, do new deals. Are you going to focus at all or still try to participate at all in the value add space, or is it just all going to be on development?
We would. I mean, I love the value add space. I'd love to get back to doing more of it again. It's hard for us to make sense of the pricing right now,
Right.
but to the extent there's opportunity, and it wouldn't even have to be much of a hiccup. I mean, if we saw an opportunity there, we'd go full speed back in. It's fun. It's a great business.
Yeah.
It's really it's gratifying to take an older asset and to give it new life and to improve the lives of the folks that live there by giving them a good place to live. So I love it. I think we'll be back into it at some point.
So you and I have both been in business a while. You a little bit longer than me. I was in banking when you were leaving and being a lawyer. But it's been a really good industry for both of us. We've certainly done well, both professionally as well as a rewarding business. As you mentioned, you get to take kind of a broken place and make it better, or a piece of dirt, a patch of dirt, and then build something beautiful on it. It's kind of what you transition to. If you're talking to someone that's trying to break into our industry coming out of college, what advice would you give them to try to break into the multifamily business?
Yeah, it's a great business. I mean, that's the first thing I say. Just to your point, it's a fun business. Every day is a little different. You're constantly challenging your mind in all sorts of ways. So really, to get into the business, I think just getting the fundamentals down is key. I mean, learning the modeling, learning kind of the economics of it is important. But there's a couple ways to come into it. I mean, sort of some folks start kind of in the real estate business. Some come into it from banking or law like we did, which is also good to kind of come in with a different perspective.
Sure.
But I would say just learn as much as you can about how it works and drive around and look at the areas you're interested in and see what's happening and get on the ground and talk to people in it and just educate yourself as much as you can. Can't read enough.
Yeah, for sure. And I think my banking background's been invaluable. And I was a banker in the Great Recession, so I got to learn a whole lot of lessons that I didn't have to pay the economic price for by observing other people make mistakes. And I think you were fortunate enough that you got to dodge the Phoenix bullet that was coming at you and got into Texas. And I'm sure that was intentional, obviously.
Of course,
you guys saw it coming. But then some of it wasn't, some of it I'm sure was just dumb blind luck. But
I found that we're better lucky than good a lot in Texas. Sure. It's sort of, if you're here, you're going to be lucky pretty often.
But you think about it, though. You intentionally moved here. I was born here, so I just happened to be born here. But my parents moved before that, and you moved here. And the winds that are back, I mean, you're seeing the migration accelerate, the corporate, just last year, major headlines, the richest man in the world lives right next to your big development. And Oracle moved what is that, a mile, less than a mile from your development? I mean, that's just amazing. But you saw that you chose to be in a market that fostered that type of economic development and job reloads, and it's just you chose to put yourself in the path of progress, and good things are kind of help you cover up maybe some of the mistakes you make along the way as well. It's a really forgiving business. So, but anyways, as we kind of wrap up, I've known John a long time. I've observed him even longer than I've known him. He's a very him and his partner Cross are super good guys, really top-notch developers, apartment owners. John, if people want to get to know you a little bit or potentially learn a little bit more about Presidium, what's the best way for them to get a hold of you guys?
Oh, absolutely. Appreciate that. Go to our website. There's a contact page. It's presidiumre.com, and you can learn more about our developments and our projects and our investments. And we're always interested to talk to new folks who want to invest with us. And again, I think that's sort of how this democratization of the investing world is going to happen. Or just shoot me an email. It's jgriggs@presidiumre.com, and love to talk to folks who are starting in the business, looking at getting into the business. It's just it's all about relationships. Yeah. It's fun.
That's perfect. Well, John, appreciate you coming on. So for John Griggs, I'm Michael Becker. I appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.